What if you're paying thousands of dollars in unnecessary taxes on your investments every year? Let me tell you, most investors are. It's a quiet, painful drain on your portfolio that can cost you an absolute fortune over your lifetime. You work hard for your money, you invest it, you watch it grow, and then a huge chunk of your profit just vanishes, handed right over to Uncle Sam. But it doesn't have to be that way. A few simple, totally legal choices can change everything. In this video, I'm going to walk you through 7 powerful strategies that savvy investors use to keep more of their hard-earned money. These aren't sketchy loopholes. They are government-approved accounts and powerful techniques hidden in plain sight within the tax code. By the end of this video, you'll have a clear roadmap to stop the bleeding and start building your wealth way more efficiently. Let's get to it. Alright, our first strategy, and honestly, the one most people can use, is your workplace 401k. So many people just sign up, pick a contribution percentage, and never think about it again. They're missing the massive tax shield it provides right now. Think about it. Every dollar you earn gets hit with income tax. The more you make, the higher the percentage you pay. The traditional 401k is the solution. Every single dollar you put in here is deducted from your taxable income for the year. Let's make it real. Say you earn $100,000 a year and you're in the 24% federal tax bracket. If you contribute $10,000 to your traditional 401k, poof! The IRS doesn't see that $10,000. Your taxable income drops to $90,000. That move alone saves you $2,400 in taxes for that year. It's like getting an instant 24% return on your money before it's even invested. For 2025, you can stash up to $23,500 into your 401k. If you're age 50 or over, you can add an extra $7,500 catch-up contribution. And thanks to the Secure 2.0 Act, if you're between 60 and 63, that catch-up can be as high as $11,250, depending on your plan. Maxing this out gives you a huge immediate tax deduction. All the while, your money grows tax-deferred, meaning you don't pay a dime of tax on dividends or capital gains year after year. You only pay tax when you withdraw it in retirement, when you're likely in a much lower tax bracket. It's the single most powerful tool for cutting your current income tax. Okay. The 401k is fantastic for lowering your taxes today. But what if you're worried about taxes going up in the future? Or what if you expect to be in a higher tax bracket in retirement than you are now? That's a real concern for a lot of young professionals and smart investors. This is where our second strategy, the Roth IRA, comes in. It does a total 180. With a Roth, you contribute on after-tax dollars. That means you don't get an immediate tax deduction. And I know what you're thinking. Why would I ever give up a tax break now? Here's the incredible promise of the Roth. Once that money is in, it grows completely, 100% tax-free. Forever. All the earnings, all the growth, for decades. It's all yours. When you hit retirement and start taking qualified withdrawals, every single penny is tax-free. No income tax, no capital gains tax, nothing. Imagine your account grows to $1 million. In a traditional account, every withdrawal is a taxable event. With a Roth, that entire million is yours to keep, tax-free. For 2025, you can contribute up to $7,000 a year, or $8,000 if you're 50 or older. Now, there are income limits. For 2025, you need a modified adjusted gross income under $150,000 as a single filer, or $236,000 if you're married, filing jointly to contribute the full amount. But for those who qualify, it's the ultimate power play against future tax hikes. This next one is my absolute favorite secret account because everyone thinks it's just for Dr. Bills. In reality, it's the most powerful retirement and investment account that exists. Period. I'm talking about the Health Savings Account, or HSA. To get an HSA, you need to be enrolled in a high-deductible health plan. But if you are, you've unlocked what I call the triple tax advantage. It's the only account that does this. First, your contributions are tax-deductible, just like a traditional 401k. For 2025, you can put in up to $4,300 for self-only coverage or $8,550 for family coverage. This immediately lowers your taxable income for the year. Second, the money in your HSA can be invested and grows completely tax-free, just like a Roth IRA. You can buy stocks, ETFs, you name it, right inside your HSA. And third, when you withdraw money for qualified medical expenses, it's 100% tax-free. That's the triple crown: tax-deductible contributions, tax-free growth, and tax-free withdrawals. But here's the pro move. Don't use your HSA for current medical bills. Pay for those out of pocket and keep all your receipts. Let that HSA money stay invested and compound tax-free for decades. It becomes a supercharged retirement account. After age 65, you can pull money out for any reason. If it's not for medical costs, you'll just pay ordinary income tax on it, exactly like a traditional 401k. But if you use it for medical expenses in retirement, which, let's be honest, are inevitable, it remains completely tax-free. It's an unbeatable tool for building tax-free wealth. Okay, we're about halfway through and about to get into the more advanced stuff. If you're having some aha moments and seeing how much money you could be saving, do me a quick favor and hit that like button. It really helps the algorithm get this video in front of more people who are unknowingly giving their money away. And be sure to subscribe so you don't miss out on more tips like these. Let's shift gears to your taxable brokerage account, the one where every dividend and bit of interest gets taxed each year. For anyone in a high tax bracket, this is a major drag on your returns. The problem is that income from most bonds, like corporate bonds, is taxed at your highest ordinary income rate. You could easily lose a third or more of that interest to federal and state taxes. The solution? An investment the government itself has made tax-free: municipal bonds, or MUNIS. These are loans you make to state and local governments for things like schools and bridges. And here's the magic: the interest you earn from most municipal bonds is completely exempt from federal income tax. Even better, if you buy MUNIS issued by your own state, the interest is often triple tax-free, exempt from federal, state, and local taxes. Let's break it down. Say you're in the 35% federal tax bracket. A corporate bond paying 5% interest only gives you a 3.25% return after taxes. But a municipal bond paying 3.5% gives you that full 3.5%. The tax-free nature makes a lower yield much more powerful. For investors who want stable, tax-efficient income, munis are a cornerstone of a smart portfolio. This next strategy is incredibly simple, but countless investors get it wrong and pay dearly. It all comes down to understanding the difference between being a short-term trader and a long-term investor in the eyes of the IRS. Here's the painful scenario. You buy a stock, it pops in a few months, you sell to lock in the profit, and then you get a tax bill that makes your jaw drop. That's because you triggered short-term capital gains. Any investment you hold for 1 year or less is a short-term gain, and it's taxed at your ordinary income tax rate, the highest rate you pay, which can be up to 37%. The solution is simple: patience. Just by holding that exact same investment for 1 day longer than a year, your profit is reclassified as a long-term capital gain. The tax rates on these are way lower: 0%, 15%, or 20%, depending on your income. For most middle and upper middle class investors, the rate is 15%. Think about that. You could pay 32% on a profit if you sell on day 365, or 15% if you just wait and sell on day 366. For 2025, a single filer with taxable income up to $533,400 falls into that 15% bracket for long-term gains. By just paying attention to the calendar, you can cut the tax bill on your winning investments by more than half. It costs nothing but a little discipline. It's an unavoidable part of investing. Not every stock is a winner. You're going to have some that go down. Most people either ignore these losses or sell in a panic, but smart investors use them as a tool. The problem you're solving is paying taxes on your gains. Let's say you sold some stocks for a $10,000 profit and now you owe the government. The solution is tax loss harvesting. This is where you strategically sell some of those losing investments to realize the loss. Here's how it works. That loss you just took can be used to directly cancel out your capital gains, dollar for dollar. So if you have a $10,000 gain from stock A and a $10,000 loss from selling stock B, they wash each other out. Your net capital gain is zero. Your tax bill on that gain is zero. And here's where it gets even better. If your losses are bigger than your gains, the IRS actually lets you use up to $3,000 of those extra losses to lower your regular taxable income. That means even your day job paycheck gets a little tax relief. Any leftover loss can be carried forward to future years to wipe out future gains or income. The one key rule to know is the wash sale rule. You can't sell a stock for a loss and buy it right back the next day. The IRS makes you wait 30 days before repurchasing the same or a substantially identical security, but you can immediately reinvest that money into a different but similar investment to stay in the market. It's a brilliant way to turn your portfolio's losers into a tax-saving winner. For our final strategy, we're diving into one of the most powerful tax shelters out there: real estate. I'm talking about a concept that lets you generate huge paper losses while your property is actually making you money. This is the magic of depreciation. Here's the problem for a landlord. You collect rent, pay your expenses, and the profit is taxable. The solution is depreciation. The IRS lets you deduct a portion of your property's value each year to account for the wear and tear on the building. For a residential property, you get to depreciate it over 27.5 years. So if the building, not the land, is worth $275,000, you can take a $10,000 deduction every single year. This isn't a cash expense. No money leaves your pocket, but it can wipe out your taxable rental income, letting you be cash flow positive while showing a loss on paper. But here's the advanced loophole: a cost segregation study. This is an analysis that carves out parts of the property that can be depreciated much faster, like carpets, appliances, and fixtures, over 5, 7, or 15 years. Plus, recent tax laws allow for bonus depreciation, letting you take a large write-off up front. While it used to be 100%, the rate for 2025 is 40% for qualifying property placed in service during the year. A cost segregation study can unlock these massive upfront deductions, sometimes worth hundreds of thousands of dollars, that can shelter your rental income and even other income from taxes. It's how real estate pros legally pay zero taxes for years. So those are 7 powerful legal strategies to shield your investments from taxes. We covered the foundational power of the 401k to cut your current tax bill and the Roth IRA to lock in a tax-free retirement. We uncovered the HSA's triple tax advantage, explored tax-free income with municipal bonds, and saw how just waiting a year can slash your capital gains taxes. We even learned how to turn losses into wins and use real estate paper losses to create tax-free cash flow. The difference between a good investor and a great one often comes down to tax efficiency. Building wealth isn't just about picking winners. It's about protecting those wins from taxes. By putting even a few of these strategies to work, you take control of your financial future and make sure your money is working for you, not for the tax man. And of course, if you want to keep learning how to build wealth and invest smarter, make sure you subscribe to the channel and hit that notification bell. Thanks for watching, and start saving. Disclaimer: the information provided in this video is for educational purposes only and is not meant to be professional legal, accounting, or financial advice. You should consult with a qualified professional in your jurisdiction for advice tailored to your individual situation.